What's going on, everybody? It's Matt, aka the Lumberjack Landlord. Yes, you still hear the echo in this room because I still have not hung everything on the walls to finish the studio, but that's okay. We're easing into it. It's now only been a month. So, want to welcome our good friend Mike Zuber to the channel. How's it going, our resident economist?
Oh, it's going very well, thank you.
So, I want to talk about banks today. I put out an alarming video last night because Citigroup and Chase literally had gone to the Fed saying, we're concerned with what your capital reserve requirements are and what that's going to mean for us doing business. So I think the good news is the Fed's clearly has a lot of pressure on these banks to have these massive reserves piles. The downside to that is clearly what they're echoing from a concern perspective is this might strain lending a little bit. So because you are the resident economist, because you speak bank fluently, explain to people what kind of that means. Because we've been talking about it for almost a year now, that this is the next step in the cycle. So let's talk about that.
Yeah, so there's so much going on here around banks, right? First, to step back, you and I have talked about there's a housing market, which everybody talks about, but almost nobody talks about the lending market.
That's right.
And whether you like it or not, the lending market actually drives the housing market. So it's really funny when no one talks about it and then they get surprised. That's why you and I follow the lending market. So again, watch the lending market because lenders are getting scared. And I would tell you it is just started.
Oh, yes.
So what happens when a lender gets scared? Well, today is Friday the 14th. You had bank earnings from Morgan Stanley, Citigroup, Wells Fargo, and JP Morgan. 3 of the 4 reserved almost $2 billion combined for what's called bad debt. Let me just tell you, a bank doesn't set aside $2 billion, or banks, I should say, banks don't set across $2 billion when they think it's all sunshine and rainbows. That's scary, right? Taking a loss on a loan for non-payment or write down or whatever, not a good thing, not a good business practice. So scared, number one. Earlier in the week, we learned that credit availability, which means just what is out there and available, is now at a 9-year low and going lower.
Yeah.
Home equity lines, credit cards. I've seen notes from followers. It's like, hey, my credit card just got cut in half, right? My limit, my home equity line just got canceled or got brought down to where the base was, right? So not closed, but no availability. So again, credit availability is going down and getting worse. I just completed interviews with a couple of non-QM lenders this week. When banks get nervous, guess what happens to rates? They go up. The spread goes up. All this stuff is happening in real time. And then you get the biggest of big banks. Let's just take JP Morgan because I'm actually a stockholder. It's the first stock I bought in 15 years. Yeah, it's 20 shares, so don't get too excited.
I know everyone started rooting for your demise. I hope it goes to 0, Mike.
I got 20 shares.
I lost $400.
Yeah, it doesn't matter. Just doesn't matter. But again, I mean, for me, it's a big deal.
Tiptoes in the mud.
So I've been reading stuff about JP Morgan. It's what you should do if you have a stock. So here's JP Morgan telling the Fed, stop. So right as of today, or at least as of the article I read, which was yesterday, roughly speaking, JP Morgan has 1.2 trillion, that's with a T, in cash.
Yes.
Right. They have to have reserves, which is required, right? So what they're concerned about is what the bank will say is, hey, if you make me increase this by 100 basis points, which no novice knows what the hell 100 basis point is, it's 1%.
Yes.
What JP Morgan says, if you raise my capital requirements, which currently sits at $1.2 trillion by 1%, again, the bank will say 100 basis points, but it's the same thing. I'm going to have to withdraw or potentially withdraw $160 billion of lending, which, oh, by the way, if you suck out lending, it will accentuate or make a recession worse.
Yes.
Right. So there's so much. It's all bad. It's just all bad. Rates are going up. Access to this. Wall Street's not buying. Rates are going up. So again, what I'm telling people is get creative. Use the 50-40-10. I just did a video with Stephen Dow on my channel showing him how to get a blended rate sub 5% on 90% LTVs. It's pretty powerful. So yeah, folks, again, if you're just writing offers with bank loans, it's going to be really tough to get a deal done with cash flow. But if you get creative, like I know you just did one.
Sure.
You can still make deals work, but you got to find the right situation. So, but yeah, banks are getting nervous, scared. The Fed could come in and go, "Hey, Jamie, 1% or 100 basis is not enough. You need to go up 2." I mean, this credit availability going down, costs going up. That's what happens when they get scared.
Yeah, what most people don't remember is that this happened in 2019, I believe. Towards, right?
Yeah, I think it was late 18,
18,
actually. 18.
Yeah,
Q4
so
18.
yeah, so towards the end of 18, this happened. And
Yep.
so
Yeah,
markets,
because of QT.
correct. So markets choke a little bit, and then things start to clear up and free up. But what I think the issue is that everyone thinking that this happens quickly, right? It doesn't happen quickly. It's
No.
literally like watching a car crash in slow motion. You know that there's going to be damage. You know it's going to be bad. You don't know to the effect that it's going to be bad. Go ahead.
Yeah, no, I just think that's a great imagery, right? We've all seen action movies, right? And
Yep.
when the car, you know the crash is coming, but you're
Yeah.
like seeing, right? Now it's just like, well, I'm just gonna get the popcorn ready because this is gonna take a while. This is a train. This is probably not a car. This is a train, right? And you could see that the engine is off the track, but you still got 100 other carts or whatever the hell they call those things.
Yep.
It's not going to be pretty.
The big caution that I would have is I just put a deal under contract today at a 6.5% rate.
Okay.
That's a good rate. I was pretty excited.
Yeah.
6.5 rate. It's a pretty good rate for an investment property, especially
Today, yes.
having, 30 or 40 mortgages. So I was pretty happy with that number. Now, what I was told was they're not going to lock that rate until 3 days before closing.
Oh, there's a good chance it won't be 6.5.
Exactly.
I'm going to take the over.
Exactly, right? So here's the thing. Just so long as you're writing deals the right way, I'm not going to get stuck with an alligator. Now, here's the thing. This deal is multifaceted. One, it's next to a lot that I already own. Two is it has Section 8 tenants already, so it allows me to expand my base without making any extra effort. Three is there's no make-ready costs in this building at all. They've done heating systems, roof, and siding, windows all in the last 5 years. So this is truly about as ready-made as I buy product. This is about it. Now, all of that being said, I still put an out clause. I still have out clauses. I still have the ability to get out of this deal if it's bad. I can still walk away from my $5,000 deposit if I needed to. So what's most important with things being so heavily weighted and moved, if by chance that rate goes from 6.5 to 7.5, I have to strongly consider if I still can do that deal or if I should do that deal. Challenge for me is this one really is super rare because I'm on a butter. I'm actually not only in a butter to the side, I'm in a butter to the backyard.
So tell people what that means. Most people don't know your fancy vocabulary.
So an abutter is when you share a lot line with a given property. And so what the challenge is when you want to do a project on your property, they do what's called a notification of abutters. And that's all of the people that share a lot line with you. Well, I would share a lot line with this house. I share a lot line with this house, but I already own it. And I share a lot line with this house over here that I don't own. But that means that 2 out of the 3 abutters, while they might be obnoxious, I know that they're going to be amenable to my plan.
Probably.
The one abutter is a different story, but this is critical when you're looking at potentially value add and value investing is anytime that you can control that future on a project that might be a 4-plex that I can build when the economy's absolutely been decimated, I can probably build that thing for pennies on the dollar, and it's going to come down to the abutters. And if I can actually own that abutting, I'm in a much better position to do the deal. So I would tell people, if you're doing deals, I think that that's still great. It has to be a great deal, but it also has to have all the caveats in it that give you the ability to get out more than it ever has in the past. This is really critical to making sure that A, you can get your deposit back, and B, worst case, are you better off losing a couple $1,000 on deposit than you are getting into a horrible deal? Sadly, you probably are. Any thoughts on that, Mike?
I think that's really wise. And again, folks, we went from an environment the last 2 years, we had to waive all conditions. We're now in an environment we can add almost any condition you want. So use it to your, people don't realize we're just in a different environment. So, I've told investors to take their experience from the last 2 years and throw it away and start it new. So, no, I think you're very wise. I like it.
I think it needs to be, people need to have changed it up. If you're doing the same thing that you were 6 months or a year ago, you're doing it wrong. You have to be, the most important thing about being a real estate investor and a great operator is the ability to pivot. You must pivot, you must change strategy, and even in crazy ideas, be the first one to do it. It's not the worst thing. This is the first deal that I've gotten closing costs included on in probably 2 years. I basically just said, yeah, you know what? I got a decent rate. I can pay close enough to the price. All of the big boxes were checked for me. All the expensive things are taken care of. Section 8 tenants already in place, which by the way of which it really drove the valuation of the property. They have not done a rent raise there on Section 8 in 5 years.
Oh, geez. Wow.
They are
how many units?
2. It's a duplex.
Okay.
But they are, to give you an idea, in market 5 years ago, that unit was a $1,425 unit. Now it's a $1,950 unit.
There you go.
They've left $500 a month on the table for 2 units.
Yeah.
I'm creating $1,000 in additional cash inflow, and it's only by sending a letter. That's all I have to do to get that Section 8 increase is send a letter. So
nice.
Hopefully this is helpful to people, but Mike, tell everybody where they can find you.
One rental at a time, and I do a Saturday live stream at 8 a.m. for 60 minutes. The sooner you join, the better your chances of getting a question answered.
That's very true. I'm waiting for people to start waiting in tents, hanging out for that live stream to start. It hasn't started that way yet, but it will.
No, not yet.
But it's mainly because you're on the West Coast, because I can start it. It's only 11 o'clock on my time. So as I always say, we try and create great content for you. Please make sure you subscribe. Also tickle that like button for us and check out the video that I did on DIY cost seg. If you are not planning on looking at least having a free conversation for 15 minutes on cost seg, you aren't taking your business very seriously. It's just that simple. It's a free 15-minute call, no obligation. Check out the video, connect with them through the Calendly app, and you guys will have the opportunity to get a free consultation on whether or not DIY cost seg, easy enough for me to say, will help you. Thanks, Mike. We'll see you in video number 2.
You got it.